Picture this. You handed your money to one of the most respected financial firms in the world. Not a sketchy offshore fund. Not a crypto startup. A firm with $300 billion under management. A firm that promised you quarterly access to your own capital. A firm that called their product a sophisticated alternative to volatile public markets. And then one morning in February, you opened your email and the answer was no. Not a delay. Not a technical issue. A gate. Your money is locked. The fund needs time to sell assets. When the process is complete, you will receive approximately 30 cents on every dollar you tried to withdraw. The rest will follow. Eventually. Maybe. That happened. February 19, 2026. Blue Owl Capital. Real investors. Real money. Real letters saying you cannot leave. Now here's the question I need you to sit with before I show you everything else. If that can happen at a $300 billion firm with institutional backing and decades of credibility, what does it mean for every other fund running the same model? What does it mean for the $2 trillion private credit market that ordinary Americans poured their savings into over the last decade? Because here is what the Moody's number actually means. It has 80 years of backtested data. It has never crossed the 50% threshold without a recession following within 6 to 12 months. It is sitting at 49% right now. And that reading was calculated before this week's numbers hit the system. The last time it was this elevated outside an actual recession was September of 2007. 1 month before Bear Stearns hedge funds started breaking. 13 months before Lehman Brothers fell. Nobody on television is connecting these dots for you right now. That is exactly why this channel exists. What you are about to see is not a prediction. It is a pattern. A 4-phase sequence that has played out in 1929, in 2008, and in the 2011 European sovereign debt crisis. Always the same order. Always the same destination. The names change. The instruments change. The mechanism does not. And right now, in the spring of 2026, Phase 3 is active. The fracture is visible. The window to act is still open, but it is not wide. Stay with me. Because by the time you finish this video, you will understand what Blue Owl's gate actually signals, why 30 cents on the dollar is just the beginning, and what history says you should do before Phase 4 arrives. Before I walk you through the evidence, I need to give you the structure. Because none of what you are watching in markets right now is random. What looks like chaos is a system behaving exactly as designed. It has a shape. It has a sequence. Think of it like a bridge carrying too much weight. You cannot see the stress in the steel from the road. The engineers monitoring the sensors can see it. The cracks appear first at the joints, never at the center. And by the time the center fails, the joints have been screaming for months. I call this the 4-phase cycle. It does not care about politics or which party holds power or what the financial media is covering. It runs on its own mathematics. And it has a track record across a century. Phase 1 is the foundation. Debt accumulates. Leverage grows quietly inside corners of the system that regulators either cannot see or choose not to examine. Asset prices rise. Confidence reaches dangerous levels. Warning signals exist. They get explained away. This is the phase where you hear this time is different, over and over, until it stops being different. Phase 2 is the overextension. The system does not just grow here. It distorts. New financial products appear promising institutional returns without institutional risk. Retail investors flood in late, right as the professionals are calculating their exits. The leverage from Phase 1 becomes load-bearing. Nobody wants to be the one to remove it. Phase 3 is the fracture. Something cracks at the edge. A regional bank. A mid-size fund. One asset class behaving strangely on a Tuesday. Officials say isolated. Analysts say contained. But the fracture is not the crisis. The fracture is the proof that the crisis has been running longer than anyone publicly admitted. Phase 4 is the transfer. Not always a crash. A transfer. Wealth moves from the people who did not understand the system to the people who did. From paper promises to real assets. History calls it a correction or a reset. The people living through it call it something else entirely. The question is never if Phase 4 comes. It always comes. The only variable is which side of it you land on. Now let me prove this to you. Not with theory. With history. The year is 1929. Phase 1 spent an entire decade building. The 1920s. American industry expanding. Stock markets climbing year after year. New financial instruments called investment trusts let ordinary people buy into leveraged portfolios they did not understand. Margin lending exploded to levels nobody had ever seen. By 1929, investors were borrowing 90 cents on every dollar of stock they purchased. $1 of real money supporting $10 of market exposure. Across millions of accounts. On every major exchange. The Federal Reserve knew. They had the data. They debated privately for months. Then they raised rates sharply. They did not explain to ordinary Americans what that meant for portfolios built on borrowed money. Phase 2 was the vertical climb. Between 1925 and 1929, the Dow Jones Industrial Average tripled. The public poured in. Shoeshine boys were giving stock tips in the street. Phase 3 arrived in the final week of October 1929. Thursday, October 24th, 12.9 million shares traded. A record. Panic spreading across every floor. Tuesday, October 29th, 16.4 million shares changing hands. The Dow collapsing 23% across 2 days. Here is the detailed textbook skip. The banks did not fail immediately. The crash was Phase 3. The banking collapse was Phase 4. It ran from 1930 to 1933. More than 9,000 American banks failed. The market lost 90% of its value from peak to bottom. Phase 4 lasted a decade. An entire generation never trusted banks or markets the same way again. And here is the detail that should stay with you permanently. In February 1929, 8 months before the crash, the Federal Reserve sent a private letter to member banks warning them to stop extending credit for stock speculation. Private. Not shared with the public. The institutions at the center received the warning. The ordinary investors who had borrowed their life savings to buy stocks on margin did not. The information existed. It was not distributed equally. Check. Verified. Undeniable. The year is 2008. Phase 1 built across a decade of deregulation and cheap credit. Wall Street had taken the American housing market and converted it into a global speculation machine. Mortgage-backed securities. Collateralized debt obligations. Synthetic derivatives stacked on top of other derivatives, layered until the original asset was buried underneath so many financial instruments that almost nobody could explain what they actually owned. Phase 2 was the expansion. Between 2000 and 2007, American home prices rose 80% nationally. Wall Street packaged the debt and sold it globally. Rating agencies stamped AAA on instruments that deserved nothing close to that rating. Every institution modeled the risk. Every model assumed home prices would keep rising. They did not. Phase 3 arrived in August 2007. 2 Bear Stearns hedge funds collapsed. Officials said contained. Analysts said isolated. The financial press moved on within days. 13 months later, September 2008. Lehman Brothers filed for the largest bankruptcy in American history. The next morning, money market funds broke the buck. The commercial paper market froze. Within 72 hours, the entire global financial system was 48 hours from complete seizure. Treasury Secretary Hank Paulson told Congress in private, "If you do not act right now, there will be no economy to discuss by Monday morning." Phase 4 required $800 billion in emergency bailout funding. Trillions in Federal Reserve interventions. A decade of near-zero interest rates to hold the system together. Those near-zero rates created the conditions for the next cycle. Here is the connection that matters. The crisis did not begin when Lehman fell. It began in the repo market months earlier. Bear Stearns was the edge crack. Lehman was the center collapsing. By the time the center fell, the people who had read the edge crack correctly had already repositioned. The people who waited for certainty got Lehman on a Monday morning with no time left to move. Check. Verified. Undeniable. The year is 2011. Europe. Phase 1 built the moment the euro was created in 1999. Weaker economies suddenly had access to borrowing rates that matched Germany's creditworthiness, without matching Germany's fiscal discipline. Greece, Portugal, Ireland, Spain. They borrowed. They spent. Debt accumulated for a decade while the math quietly stopped working. Phase 2 was cheap credit flowing into government spending and bank balance sheets stuffed with sovereign bonds everyone treated as permanently safe. Phase 3 arrived in 2010 when Greece revealed its debt was dramatically larger than officially reported. Then Portugal. Then Ireland. Then Spain. Contagion spreading from one edge of the Eurozone to the next. Mario Draghi walked to a podium in July 2012 and said 3 words, "Whatever it takes." Markets stopped falling. But notice what those words meant. The only thing standing between Europe and collapse was a verbal promise from a central banker. Phase 4 was austerity. Government workers fired by the thousands. Pensions reduced. Public services eliminated. In Greece, the economy contracted 25% over 5 years. A depression. Not a recession. A depression. Ordinary Greeks paid for a decade of financial system excess with their jobs, their savings, and their futures. The banks were restructured. The bankers kept their positions. Check. Verified. Undeniable. Now watch carefully. Because 1929, 2008, and 2011 are not history. They are the blueprint for 2026. Phase 1 in the current cycle ran from 2008 to 2022. 14 years. The Federal Reserve held rates near zero for more than a decade. Capital poured into whatever promised yield. And the biggest beneficiary was private credit. After 2008, stricter bank regulations pushed lending into the shadows. Private credit funds. Business development companies. Non-traded vehicles sold to retail investors as a sophisticated alternative. The private credit market grew from roughly $500 billion to over $2 trillion. Ordinary investors were brought in during Phase 2, when returns looked best and risks were invisible. Phase 2 was the distortion. Between 2022 and 2025, the Federal Reserve raised interest rates at the fastest pace in 4 decades. Every hike did something specific to bank balance sheets. Banks had loaded up on long-duration Treasury bonds during the zero-rate era. When rates rose, those bonds lost value. Not reported immediately. Unrealized. Hidden. But real. Stanford researchers ran the numbers. The aggregate unrealized losses were large enough that simultaneous deposit runs from the most exposed institutions would threaten insolvency at hundreds of banks. That analysis existed before March of 2023. Then Silicon Valley Bank failed. Then Signature Bank. Then First Republic. 3 of the second, third, and fourth largest bank failures in American history. Inside 60 days. Emergency programs paused the acute stress. The underlying damage was deferred into 2026. Phase 2 also included the AI spending explosion. The largest technology companies spent over $250 billion on AI infrastructure in a single year. The Shiller price-to-earnings ratio climbed near 40. That level has been exceeded exactly once in history. In late 1999. Immediately before the dot-com collapse erased $5 trillion in market value. The stage was set. Phase 3 started where it always starts. At the edge. January 30, 2026. Chicago. Metropolitan Capital Bank and Trust closed by Illinois regulators. Assets of $260 million. Deposits of $212 million. Estimated FDIC loss, $19.7 million. Branch reopened under new ownership. Small bank. Routine closure. Contained. Move along. That is what you were told. The same week, gold and silver dropped in moves analysts called forced selling. Bitcoin fell around 8%. The Federal Reserve's New York branch liquidity stress ratio had been climbing since the first quarter of 2022. The plumbing was straining. Not collapsing. Straining. Then 20 days later, the edge cracked louder. February 19, 2026. Blue Owl Capital. $300 billion under management. They announced redemption restrictions on their retail private credit fund known as OTIC. A $1.6 billion vehicle promising ordinary investors access to middle market lending. Redemption requests had already exceeded the standard 5% quarterly cap. The technology-focused vehicle saw requests jump to approximately 15% of net asset value in a single quarter. A 200% surge. In one quarter. The gates came down. Blue Owl announced a plan to sell approximately $1.4 billion in assets across 3 funds and return only 30% of capital to investors within a 45-day window. Financial analysts used the phrase slow-motion bankruptcy. Shareholders filed a securities class action alleging the firm understated the redemption risk earlier in the year. Mohammed El-Arian asked publicly whether this was a canary in the coal mine moment, similar to August 2007. He did not ask that casually. He asked it because he remembers what August 2007 became. 2 Bear Stearns funds. Contained. Isolated. 13 months later, Lehman fell. The canary does not announce the collapse. The canary announces that the air has already changed. Check. Verified. Undeniable. Now look at the markets. The S&P 500 turned negative for 2026 on February 6 when nearly $1 trillion in market capitalization was erased across 3 days. By late March, the Dow, the S&P 500, and the Nasdaq were each recording their worst weekly losing streak in almost 4 years. 5 consecutive weeks of losses. The Nasdaq entered correction territory, down more than 12.5% from its record high. But here is the number that matters. The average company inside the Nasdaq composite had seen a 31% drawdown. Not the index. The average stock inside it. That is not a correction hiding behind a headline. That is a quiet bear market the index math is concealing. The Buffett indicator, total market capitalization measured against gross domestic product, sat at 213% as of March 2026. Warren Buffett has said this number approaching 200% should be a serious warning. Every time in history it reached this territory, a major repricing followed. The Federal Reserve held rates at 3.5% to 3.75% at both its January and March meetings. The Fed is caught inside a box with no clean exits. Cut rates and inflation reignites. Hold rates in the recession the models are pricing at 49% becomes more likely by the week. This is stagflation. Prices rising. Growth stalling. No good policy answers. The last time America sat in exactly this configuration was the 1970s. Interest rates had to exceed 20% and a full decade of pain followed. Oil was the trigger then too. Today Brent crude sits above $112 per barrel, up from below $71 at the start of February. Every $10 increase removes between 0.2% and 0.3% from GDP growth and adds 0.4% to inflation. The move from $71 to $112 creates a cumulative economic drag approaching recessionary territory on its own. The unemployment rate rose to 4.4% in February with a net loss of 92,000 payroll positions. Largest monthly decline since 2009. GDP grew at only 0.7% annualized. Goldman Sachs forecasts growth between 1.25% and 1.75% in the second half of 2026. Economists call that stall speed. One additional negative shock tips the balance into contraction. Goldman raised its recession probability from 25% to 30%. Moody's at 49%. Pantheon at 40%. Wilmington Trust at 45%. HSBC at 35%. The normal baseline is approximately 20%. Every major institution is now above it. And the Moody's AI model calculated its 49% reading before this week's additional pressure entered the system. The models do not negotiate. They follow the data. And the data is speaking clearly. Now let me make this personal. Because this is not about charts on a screen. This is about the money you worked for. The retirement account you built over decades. The savings you told yourself were safe because a respectable firm managed them. The $2 trillion private credit market absorbed capital from pension funds, insurance companies, and millions of ordinary investors who were promised steady income and a sophisticated edge over public markets. None of that marketing material included a section titled "What Happens When 15% of Investors Try to Exit in a Single Quarter." Blue Owl sold 34% of its portfolio at distressed prices. Used the proceeds to repay a Goldman Sachs credit facility. Distributed 30 cents on every dollar investors tried to withdraw. 30 cents. In the first round. The rest is being worked out. Eventually. Liquidity is not a feature of a product. Liquidity is the product. When it disappears, you discover that what you actually owned was different from what you were sold. And Blue Owl is not alone in this structure. The $2 trillion private credit market is full of funds running the same model. Illiquid underlying loans. Quarterly redemption windows. Leverage that is not fully transparent. Marks that only become visible when someone is forced to sell. Now I know 3 objections are forming in your mind. I hear them every time I make a video like this. First, this time is different. Every crisis is different in surface details. The instruments are always different. The sequence is always the same. Prices inflate beyond fundamentals. Leverage builds in the shadows. Confidence peaks. The edge cracks. Then the center fails. This time is different is the phrase most reliably associated with the exact moment before everything stops being different. Second, technology will save us. The AI productivity gains are real. But the argument confuses a genuine technological shift with a justification for any price and any leverage. In 1999, the internet was also real. The Nasdaq still fell 80% from its 2000 peak to its 2002 trough. Technology rewires economies over decades. Markets reprice in months. Third, American exceptionalism means different rules. The rules apply everywhere. The 1973 oil embargo produced American stagflation and a 52% stock market decline. Exceptionalism is a story. Markets run on mathematics. Mathematics does not make national exceptions. So here is what you actually do. 6 specific steps. 1. Stop assuming this is temporary. The 5 consecutive weeks of losses, the Blue Owl Gate, the Metropolitan Capital closure, the 49% Moody's reading, the $112 oil price, the 92,000 February job losses, the 0.7% GDP number. These are the identical cluster of signals that appeared at Phase 3 entry in 1929, 2008, and 2011. The direction of the pattern is not ambiguous. 2. Audit every illiquid alternative you hold. If you own any non-traded business development company, private credit vehicle, or interval fund with quarterly redemption windows, you now have documented proof of what those windows look like under stress. Blue Owl's investors found out what gating means. You do not want to find out the same way. 3. Understand what survived Phase 4. In 1929, gold preserved purchasing power while equity markets lost 90%. In 2008, short-duration treasuries and gold were the primary refuges. Companies with clean balance sheets, real cash flows, and minimal debt have outperformed in every Phase 3 to Phase 4 transition. The leveraged, the speculative, and the highly valued with no earnings are precisely what Phase 4 destroys. 4. Do not wait for official confirmation. The NBER declared the 2008 recession began in December of 2007. They made that announcement in December of 2008. 12 months late. By the time the official label exists, Phase 4 is already running. 5. Watch 4 signals over the next 30 days. The April 4th jobs report. Whether oil holds above $100 per barrel. The April 28th FOMC statement. Whether any additional private credit funds announce redemption restrictions. If 2 or more deteriorate simultaneously, the Moody's model crosses 50%. When it crosses 50%, the historical record for what follows within 12 months is not a forecast. It is a precedent. 6. Talk to the people who depend on you now. The families who navigated 1929 with the least damage understood what was happening before the center failed. You now have the fractured data. You have the model probabilities. You have the pattern. The canary already stopped singing. If you like this video, hit subscribe right now. Thanks for watching.